With the price of silver being where it's at today, the solution is to stack, 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 according to my guest today, Alasdair Macleod, who admits he doesn't have a price target for silver and he doesn't know when it's going higher. But for those sitting on the sidelines hoping for a further correction, they may be sorely disappointed when the metal goes into the stratosphere up ahead. A move he believes is driven not by the appreciation in the price of silver, but by the debasement of fiat currency, and he believes the fiat system collapse is coming up ahead. We're going to talk about that, as well as the new gold clearing system in Hong Kong and what that means for the market, the new energy crisis based on the Iran war and the parallels with the Arab oil embargo of the 70s and what gold will do in such a scenario, and so much more. And guys, the first Commodity Culture Boot Camp happened very recently. We got amazing feedback. It was a great session. The replay is still available for a limited time. Use the link in the description, join.jesseday.ca. And now, Alasdair Macleod. Alasdair Macleod, it is great to have you back on Commodity Culture. I want to kick things off, as I often do, with the silver market. We seem to be stuck at around the $60 range since a fairly sharp drop in price from around 70 at the end of last month. Are you viewing this as a buying opportunity, a time to exercise caution? And what is your outlook for the silver market for the rest of 2026?
Well, silver is very volatile, and the only way to treat it is stack, 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 in my view. The price doesn't really matter in the sense that what I'm doing when I buy silver is I'm just getting rid of fiat currencies. That's the main thing. I'm trying to sort of guess where it's going, and using charts and all this sort of stuff is not really the point. And I'm pretty certain that once silver moves, and I don't know when that'll be. I mean, I've got opinions, but I can't do more than that. When it really moves, I know one thing for absolute certain: all those people who've been going on about, I'm going to buy silver, when I think it's right, well, they'll miss it, and then they'll be trying to catch their tails. You'll find it's $100, $120, $150. Oh, it's got to come back. I mean, it's going up too fast. It's got to come back, and then I'll buy it. $200, $250, $600. Oh, I better buy it. 10 times above where it is now. I mean, that's what happens. This is my experience of traders. Some traders get it right, okay, which is good, but they are a minority, and all this fooling around, trying to double guess markets and all the rest of it, it misses the point. What we're actually seeing is the death of fiat currencies. And in that case, I mean, you may as well go and buy copper, you could buy gold, you could buy oil, you could buy, anything that you can take delivery of, you should buy just to get the hell out of fiat currencies, because they're going to zero. But there will always be a need for silver, gold, copper, oil, whatever. So that's what you should own.
The Silver Institute projects the market will remain in structural deficit for a sixth straight year here in 2026, with mined silver production expected to rise only modestly, around 1%, according to some forecasts. Surely we're reaching the point where the physical supply-demand imbalance has to trump paper speculation. Would you agree with that?
Yeah, I think you've got to, people have got to understand actually what's been happening with silver. The Silver Institute is right. I mean, you can draw up supply, demand, surplus deficit type charts as much as you like. But actually what's been happening is that the silver price has been managed by China. China is it's the largest importer of the sources of silver, which are non-ferrous ores, particularly copper, zinc, to a lesser extent lead, and also gold. That's where it all comes from. I mean, over 70% of silver comes from that. And as a result, basically China has been accumulating huge amounts of silver for a very, very long time. It's part of official policy, not publicly declared. They don't go out and tell us this month we bought this month we refined so much, and that produced so many tons of silver. No, of course they don't. They don't tell us what's going on. But believe you me, the policy going back to 1983 has been to accumulate gold and silver. And the PBOC has total responsibility for the acquisition of gold and silver. Now, what's happened is that in the last however many years, when you've got this deficit, which quite correctly comes out of the Silver Institute's tables, that has been made up by China exporting silver to satisfy demand. Why? She's been keeping the price of silver under $50. So, and then this changed. This changed sometime, I would guess, in sort of late September, early October, probably late September, along with rare earths. I mean, the rare earth story had been brewing up for a little while. But quite clearly, China was not going to export silver for America, which had then decided it was a critical mineral to supply America. So what did she do? She reversed her policy. And we saw silver jump from $50 in sort of, I think it was sort of early October, all the way up to 120. And if you look at what China has done in the first quarter of this year, she has bought a total, I think the figure is 1,626 tons. Now, we haven't been given any export figures because usually there's imports and exports. But for some reason, there hasn't been any export figures, if you like, issued. Now, this 1,626 tons annualized, we're looking at about 5,000 plus tons. Now, this, if you like, compares with the roughly 3,000 to 5,000 tons which China has been exporting every year recently to satisfy and to deal with that supply deficit in the West. So, in other words, this is a completely volte-face. And it's fascinating that she has acquired all this silver at a time when we've been trying to get the hell out of it. I mean, this is part of a wider policy, actually, because at the same time, China has imported 163 tons of non-monetary gold. That was up to May. We haven't had June's figures yet. And on top of that, there's a further 40 tons recorded of non-monetary gold. So that's an addition to the 163. So around about 200 tons gold. And that's what's been reported. I mean, it could be, the truth very often in these things is somewhat different. So what's she doing? What's she doing with stockpiling copper? What's she doing, sort of ceasing exports of things like fertilizers and sulfuric acid and so on? I mean, the answer to this, quite simply, is she doesn't want any dollars. Her trade surplus is now hitting records. So she's earning foreign currencies, which she knows are going to go to zero. She doesn't want them. So if you like, you could put it that China foresees a situation that's not prices rising, but the currencies falling. And she's indulging, if you like, in a central bank's version of a crack-up boom, which for people who don't understand what it is, I mean, this was something that the economist Ludwig von Mises wrote about because he experienced the demise of the Austrian shilling and also observed the demise of it was the Austrian crown in those days. He also evidenced the hyperinflation in Germany, which lagged the Austrian one just slightly. And he observed that in around about the last 5 or 6 months of this, this collapse of the currency, people suddenly realized that it wasn't prices rising, but the currency going down. Now, the moment they realized that, they dumped the currency for anything, just to get rid of it. They bought anything, even if they didn't need it. They just wanted to get rid of wheelbarrow loads of this rubbish. And that's precisely what China is doing.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Now, correct me if I'm wrong here, but I believe China is the number one gold producer and the number two silver producer in the world. So while a lot of people are paying attention to the import exports, is China officially reporting all of the silver and gold that they're mining? And how much of that do you think they're taking into their own reserves as opposed to exporting to other countries?
Well, I mean, the answer, I've always maintained that with respect to gold, China is like Hotel California. You know, you're welcome to come in, gold ingots, but you ain't leaving, if you see what I mean. So on that basis, it's really, anything that she's mined, she has kept. So you can add that, if you like, to the balance of, exports, imports. I mean, there've never been any exports. But interestingly, in the last week or two, it's become evident that that is changing. What happened is that the People's Bank of China issued a note saying you no longer need to ask our permission, the central bank's permission to export gold. It's just a customs matter. What that means is that people owning gold in China can send it from China to Hong Kong as part of this new market. I suppose they can send it anywhere, but it's still got to go through customs. So I guess that they're probably restricted to this new Hong Kong, if you like, market development. So you've now got freedom of movement in gold between the Shanghai Gold Exchange and the new Hong Kong market. So that is a big, big change. And that's happened literally in the last 10 days or so.
Yeah, I want to touch on that because Hong Kong has launched a new gold clearing and settlement system. At least 6 major banks signing on, including JP Morgan, Deutsche Bank, and many others. Hong Kong's chief executive, John Lee Ka-chiu, stated, "The launch of Hong Kong's central clearing system for gold will create a historic foundation, allowing us to take the next major step, and that's building a comprehensive gold trading ecosystem. If gold is the world's safe haven, Hong Kong will be its safe harbor." Very interesting development. What do you think it means for the global gold market as well as the gold market within China? You've alluded to it, but would love to get some more thoughts from you.
Yeah, it's quite simple. You've got to look at this in connection with earlier moves that the People's Bank and the SGE have done. Bear in mind, the SGE is owned and run by the People's Bank. So, when we talk about the People's Bank and the SGE, we're really talking about one organization. What they did was they opened a vault in Hong Kong, which was an exchange facility, if you like, for gold for Chinese yuan or Chinese yuan for gold for anyone. And it all fits in with the new payment system, the SIPS payment system, which they've put together. And they've also, interestingly, been opening another vault in Saudi Arabia. And there's talk about these vaults being new vaults being opened in Southeast Asia. There was stories that they would probably open one in Dubai, though events have rather overtaken that. And there was even mention, and I think it was probably a bit speculative, that they would open one in Zurich. I mean, the point is that right from the outset, China realized that fiat currencies never, ever survive. She was emerging from the Mao era into a world of fiat currencies. They weren't going to survive. So what she had to do was to play the fiat currency game, but never forget she needed to protect herself against their collapse. And this has been her policy the whole way through. She, between 1983, when the People's Bank was appointed with responsibility for the entire nation's gold and silver reserves, I mean, not talking about bank reserves, but ownership of gold wherever. 1983, she started accumulating gold in that big bear market. I reckoned, and I did some calculations, it was very much a back of the envelope type calculations, but I reckoned that at contemporary prices, she probably accumulated around about 20,000 tons by 2002. The reason 2002 matters is that the Shanghai Gold Exchange opened, and for the first time, citizens in China were allowed to own gold. And indeed, I think 4 or 5 years later, the Chinese government even advertised, they did television adverts, buy gold, it's good for you, whatever the strapline was. So you can see that there's been a deliberate policy here. They've also, as you alluded earlier, they accelerated mine production very, very significantly, to the point where they rapidly overtook South Africa, which admittedly was declining in its output, and has been the world's largest gold output, miner, if you like, by output, I can't remember when the crossover was, something like 2007, 2008. So that's been, almost 20 years she's been the largest mining nation. And then we have seen this continual migration of physical gold from Western capital markets into China, never to return. So my guess is that she's probably, as the state accumulated a further 20, maybe 25,000 tons. And of course, you've also got the deliveries out of the Shanghai Gold Exchange, most of which has gone into jewelry, admittedly, into the hands of the public. That is a further 28,000 tons. We don't have scrappage figures, but anything that's scrapped has gone back into the SGE, vaulting system, and would have, it hasn't left the country, so it's still there, sort of thing. So that 28,000 tons, some of it may be earned slightly differently. And of course, the other thing is that the banks, on behalf of their customers, bear in mind, banks actually don't like to own physical things. They like paper, but on behalf of their customers, acting as custodians, they will have also acquired significant amounts of gold, which will be within the SGE vaulting system and therefore not recorded as delivered anywhere. I reckon there's probably another 5,000 tons there. And bear in mind also that they offer gold accumulation accounts. And these gold accumulation accounts run alongside deposit accounts. And the People's Bank of China's policy has been to reduce interest rates, in the wake of the property smash and all that sort of stuff. And so while the banks have been very imaginative with, trying to sort of offer deposit products, with sort of slightly higher rates, if you hold on to your deposit for 3 years, that sort of thing. The fact of the matter is that once gold starts running again, you can see that this is going to unlock huge investment demand from ordinary savers. And bear in mind that in China, the savings ratio is about 30%. Now, I'm looking at household savings, not overall savings. Household savings running at about 30% of GDP. That's the equivalent of between $5 and $6 trillion every year trying to find an investment home. In a world of declining interest rates in China anyway. Property used to be very fashionable, but no more. Stock market, yeah, maybe some interest there. But you can see where this $5 or $6 trillion is mostly going to go to. And this is one reason it's interesting that in the recent changes, the domestic market has been told to stop speculating. But guess what? ICBC, I think it was reported to be reducing its expense ratio, its expenses, if you like, on the gold accumulation accounts. In other words, encouraging real investment, but discouraging speculation, which is a fascinating topic.
Yeah, very fascinating developments overall. And you touched on it because in mainland China, there's a targeted suspension of leveraged retail paper gold services by major banks, encompassing leveraged or margin-based paper gold products. Now, some reports circulating on social media are saying China's banned paper gold altogether. This is not the case, as institutions are still allowed to engage in that market. But taking a step back, what do you see as the motivation behind this move?
I think it's quite simple, and I think that the guys on Comex, like the swaps, would love to be able to do this. I mean, in China, the banks just they're short because just like the swaps and the bullion bank trading desks in Comex, they're short while everybody else is long. The speculators are long and they're short. So how do you close your positions if you're short? You just tell everybody to close their positions. That's exactly what they've done. And you make the point that institutions can still run paper positions. Yeah, that's right. But they want out basically, so they just tell everybody close, bang. That's it. We're not offering any new any novation, if you like, of your positions after July the 24th. I mean, I reckon the guys in the swaps who are short, and they have been horribly short. When the price was up at $120. I mean, like some of them were facing death, financial death. I mean, they must be looking at this and think, "Oh, I wish we could do that." I mean, the way they will do it, and the way I mean, you've already seen open interest fall to the lowest levels for, decades. And basically, what they're doing is, you want to buy a silver contract. I mean, you're going to get a price spread like that. Which is a bit discouraging. So you probably don't do it. And I think that's the way they've been handling this. And of course, as each active contract expires, you find that, they're just sort of not really making a market anymore. They're just trying to close the thing down. But I mean, I think it's absolutely brilliant. In China, they just turn around and say, "That's it. We're not offering you our facilities to buy paper anymore. So you got to close it, and that's it." And look at the price too. I mean, here we are. We've driven the price down to about $60, and what a wonderful opportunity to do it. That's actually what that's about. I mean, particularly, now that the policy is, and this has got to come from the PBOC. The policy is to encourage investment in gold and silver. I mean, we've been talking about gold. I mean, that's where it's obvious, but it'll be exactly the same as silver. Less so, perhaps, because silver being an industrial metal. But certainly when it comes to gold, gold accumulation accounts, please go ahead. And of course, most of the gold which has been imported into China, while we have been rejecting it, thinking this is a horrid speculative thing which which is only going to lose us money, so we'll sell it. They've been, it's really the commercial banks who've been topping up their reserves so that they can satisfy their customers' demands for the gold accumulation accounts. Simple.
Let's turn now to the Middle East and the debacle that is the Strait of Hormuz and what appears to be an emerging energy crisis. We saw oil into the triple digits initially. It's obviously come off quite a bit, but we're still in the $70, $72 range, I believe, last time I checked. It looks like the Strait of Hormuz is closing again. It looks like the war is back on. The U.S. striking infrastructure, supposedly attacking a nuclear power plant and a bridge that connects for trade with Russia and China, by the way, which is a major escalation at this point. We were speaking before we hit record today about the parallels between today and the last energy crisis, the oil embargo of the 1970s, and how gold responded in that scenario. Maybe you could walk us through your thoughts there and how you think those parallels might be drawn to the scenario that we find ourselves in today.
Yeah, I mean, well, in 1973, and it first started in October '73. OPEC decided to raise the price of oil, and they raised it from something like $3 up to $5. And what was interesting was that the price of gold which had already fallen quite a bit, fell even further. It fell from about $105 down to 90 and I think it bottomed out on around about the 26th of November. If I look at my chart. So that was the bottom. And then it started rising. There was quite a sharp rise up to $100. A little bit of a pause. And then when in January, they moved the price up from $5 to an average of about $11.50. $11.65 is the one which sticks in the mind. But obviously different grades of oil, different values and all the rest of it. So gold had already started to rise ahead of that. But the interesting thing is that while they more than doubled the price of oil, having already risen it from $3. So all in all, they've more than tripled the price of oil in a matter of months. From that second time, the gold price then moved up to around about $175. So we went from 90 to about 175. And by the end, and by the way, that was the end of March. So this was a very, very rapid move, given that the bottom was the previous end November. So let's say so from December, January, February, March, 4 months, it sort of nearly doubled just in 4 months. The psychology in this, I think, is interesting and worth dwelling on. When we had the first move up, obviously the investors looked at it and took the view that this was economically bad news. So they sold financial assets for dollars. And one of those financial assets, of course, was gold. So, of course, the reason that an investment manager looks at it like this is he accounts in dollars. He runs his profits and losses in dollars. His customers, his clients, look at the performance of a managed portfolio being in dollars or whatever the local currency is. So his zero risk position always in accounting terms is to go back to dollars, cash dollars. Yeah. But on the second rise, and when the market got wind that this could well happen, then the sentiment changes. Instead of thinking this is bad for other financial assets, it begins to think this is bad for the currency, because you can see what's going to happen to inflation. I mean, conventionally we call it inflation. I prefer to call it what's going to happen to the purchasing power of the currency. And indeed, that falls very, very heavily on, as soon as you realize that this is happening, you can see that prices are not going to rise by, let us say, 2% by the year end or all this sort of rubbish. But you're talking about substantial rises. And indeed, in the case of Japan, which was and still is almost entirely dependent on imported energy, their inflation actually peaked out at 30%. 30%. In the case of the UK, we got up to 25%. We had all sorts of other crises as well. The story was the same throughout the G7, but, different magnitudes and all the rest of it. So that you can see, if you understand that inflation actually is a falling purchasing power for the currency, then if you're going to see inflation rise substantially, then really what you're seeing is the purchasing power of the currency falling substantially. So how do you hedge against that? You're no longer thinking in accounting terms, thinking my zero risk position is just to hold zero assets but cash. You're now thinking, what's happening to the value of that cash? It's going down. So what you have to do is you have to get out of cash into physical commodities, because commodities, they go up and down, but the reason they go up and down basically is because the purchasing power of currencies go up and down. But, if you like, the most important and legal money, which has proved itself over millennia to be stable in terms of its purchasing power is gold. So you can see that once this double take is made, then there's a very, very sharp switch from thinking I got to hold cash dollars to I got to get out of cash dollars and I got to get into real money, which is gold. That's what happened then. I can see this being a pretty good model for what's happening now, because oil is being suppressed so far by releases from particularly America's strategic oil reserves, which are now, by all accounts, close to running on fumes. So that is going to end very, very shortly. The other thing which I think is something which I'm sure historians, economic and financial historians, will debate in the future, is what actually is an oil futures contract? What actually is a silver or gold futures contract? Does it actually represent silver, gold, oil, whatever? No, it doesn't. And this is the point which I think will be debated in the future. You're looking at dollar contracts which merely use these commodities as markers, if you like, to produce profits in dollars. I mean, why does a bank run out and buy, or why does anyone go and buy a future? I mean, unless you're outside the system, basically the reason you buy it is you want to sell the future. You don't want to take delivery. You don't take delivery. The reason there's such a huge turnover in the gold contracts on the LBMA is because the banks wheel and deal this stuff, but they don't want to actually take delivery. Because if you put your balance sheet into physical assets, you're no longer doing what you actually should be doing, which is being a dealer in credit. That's what banks are. So really, these futures contracts and forward contracts do not represent the metals or the commodities which they're denominated in, but they actually represent the currencies. That's the key point. And I think this is something which I'm sure financial historians, after the collapse of this fiat currency system, will be debating with great interest.
Yeah, some great thoughts there. Now, you recently released an article on your Substack titled GDP, The Real Story. I'm going to read a quote. You said, "Judging the state of the economy using government statistics is impossible because they are designed to deceive. Amazingly, people just accept them, which will be their undoing," end quote. Now, even worse than using GDP, the US administration right now is also constantly using the broad stock market as a measure of economic health. And as you mentioned, most people just accept this. But of course, a very different story is taking shape when it comes to the middle class and their loss of purchasing power. Walk us through your thoughts on the current state of the economy in America and these statistics that are being relied upon. And when, if ever, do you think the majority, the middle class, is being crushed by the debasement of their currency? When will they wake up to the truth underneath?
They will be the last to wake up to the truth. But so let's try and give them a heads up, as it were. The point about GDP is it does not represent how credit is used. What it is, it's the total amount of credit deployed in a period of time for qualifying activities. Now, those qualifying activities are manufacturing. They are, if you like, earnings through sort of commissions and all this sort of stuff from the financial sector. Importantly, it also includes all government spending. Now, we could argue the toss about the validity of government spending, and we could be sort of take an Austrian economist view or a Keynesian economist view or whatever. But I just want to concentrate on one aspect of it, and that is the deficit on government expenditure. And if you bear in mind that all government spending is in GDP, I mean, yeah, all of it, really. I mean, it's not like the private sector where you've got quite a lot of wheeling and dealing, which is not included in GDP numbers. Just the earnings from the wheeling and dealing are included in GDP numbers. Service industries, for example. The point is that if government is running a deficit, let us say, of 5% um, on its budget, and let us assume also that it's, say, I don't know, half the total economy, then what you're looking at is credit which has been sort of produced out of thin air, which is bolstering the GDP number. But it is hot air. I mean, it really is. And so consequently, it inflates the GDP number. So if you take that out, then you will get a truer, I mean, not a true, but a truer um, estimate of nominal GDP. And you've got to also think in terms of, deflating it and whatever, but we'll put that aside. If you get nominal GDP rising by, say, 5%, and government spending, the excess of government spending over its tax revenues is, say, 7%, then take that out. You've actually got a private sector which is contracting by 2%. I mean, it's very, very simple arithmetic. If you look at the entire G7, I mean, and adjust their GDP numbers, you see they've all basically been stagnant or in recession for the last 3 or 4 years. And this is a very different picture from the one painted, if you like, by central banks and by politicians, who, of course, don't do this. And the thing that amazes me is that even economists who should know better don't do it. And the reason they don't do it is because they assume that, because they're Keynesians, they're all Keynesians, they assume that, government spending into the economy, excess spending, a deficit, is actually stimulating the economy. Well, it stimulates the numbers of GDP, but it doesn't stimulate anything else. It actually hides a contracting economy. I mean, if very, very simply, without going into economic theory, if deficit spending was really going to stimulate the economy, why is it that the economy hasn't been stimulated for years and years and years and years as the US government continually runs government deficits? That is, if you like, the point I was making. And there is a value, if you like, in GDP, but it's only a value to government. And that is that if GDP is rising, then that gives them an idea as to how much tax revenue should be rising as well. So that is something that they will look at. It's also something which overseas creditors will look at. So, certainly in the case of the US and also in the case of the UK, which has a lot of foreign ownership of gilts, foreign creditors will look at the sustainability of a government's finances with reference to nominal GDP. If nominal GDP is not growing, then they ask themselves the question, how can they afford to pay the interest on the extra debt? Not that any government ever pays interest on the debt, they just print it out of thin air. But you can see that, from an arithmetic point of view, if GDP is contracting, contracting, if you like, and at the same time debt is increasing at a faster rate, then essentially the government is in a debt trap. And that is now the situation in the US, the UK, Japan, very, very definitely, Italy. I'm just looking around the G7, probably Canada as well. So, and France, definitely. So you can see that, the entire G7 is already entering or in this debt trap. All it requires is people to understand they are in a debt trap. And then what happens to bond yields? They go through the roof. And if you look at what bond yields have been doing, I mean, they've been knocking on the door to higher rates for the last 3 years. One day they'll break out on the upside, and I think this oil crisis will probably do it. And then with debt to GDPs averaging 125% through the G7, what's the future going to look like with inflation going up towards 20%, probably exceeding it quite substantially in some currencies, and a debt to that debt to GDP thing. I mean, remember that 1973, last time we had a similar crisis, debt to GDP was only about 40 to 45%. Now the average is 125% across the G7. Would you want to own anything in credit? I would suggest no. Get the hell out of credit. Get into real money. The Chinese know this. They're getting out. They're getting out of our currencies. So this is this is actually quite a serious point in our economic situation.
Is there any connection between this scenario you're discussing, the coming collapse of the credit markets and fiat currency, and the rise of the surveillance state? Because we're seeing more and more authoritarian rules and regulations coming out of the West. Obviously, UK is all over social media right now when it comes to people being prosecuted for saying the wrong things online. This is happening in Germany. This is happening in France. Across the EU, Canada is now starting to put more of these types of laws on the books. I think in a very short order, we're going to see those same social media posts about Canada that we're seeing about the UK at present. Is this all connected to the decay of fiat currencies and the completely untenable debt situation governments are facing?
I mean, partly, I would say. I mean, there is no doubt that the political class are running scared. And when they run scared, they just want to have more control, if you like. That's the solution they believe in. So yes, that does happen. But for a long time, they've been pushing this sort of thing about money laundering and tax evasion and all the rest of it. So that's all part of it. But I think we've got another aspect which we need to consider, and that is that for reasons which, I think are beyond rational analysis, our political class seem absolutely hell bent on going to war. In Europe, you've got the three nations. You've got the UK, you've got Germany and France, and they are conspiring to go to war against Russia. I mean, it's just unreal. Nobody's got any common sense in this. And then you have this extraordinary situation of President Trump thinking he could, sort of deal with Iran in a weekend. Just a few bombs, kill a few guys, and they would say, surrender. I mean, how stupid can our political class be? But one of the consequences of this is they turn around to us. And when we say something which equates to the truth or doesn't go along with their propaganda, we end up in jail. Well, I mean, not quite, but that's the way it's going. We've got to be very careful what we say. I mean, the propaganda is all pervasive. And I mean, I even hear from some of my Substack subscribers, when I write something and, I go on facts as much as I can. I verify facts. And when I say something which, if you like, suggests that, let's say that President Xi or Vladimir Putin actually showing a bit more common sense than our bunch of clowns, how can you say that? You're supporting Russia. And no, come on. You can see that this propaganda is all pervasive. And the thing that's fascinating is that I'm still trying to work out in my own mind how when we went to war back in 1939 against Germany and expanding Germany, how the sort of propaganda then was all pervasive, and yet we accepted it. And the chief of propaganda basically was Winston Churchill, and he was a great man. I'm trying to sort of sort out in my own mind where this difference lies. I mean, I suppose the answer is that he came out a winner, but I'm afraid in this case we're coming out losers. So, perhaps the answer is to try and quietly subvert the propaganda, if you like, and just make sure that there are enough people who do understand what's happening. I mean, I think the other thing is that, back in 1939, 1940, you could enforce conscription. You could, make able-bodied men join the army, air force, or navy, and go and risk their lives for the nation, for the state. I don't see that now. I think that if in Britain, Germany, France, whatever, they try to start doing conscription, I think there'd be a complete revolt. I don't think that our politicians can actually carry their electorates as they try and prosecute a war against Russia. Well, of course, they're already at war against Russia through the Ukraine, and it's the Ukrainians who are getting killed. But there will come a point where that can't happen anymore. And when that can't happen, the way these guys are going, I'll say I'm too old to do this, but I would worry for my sons, quite frankly. It is actually quite concerning. And I think truth, if you like, is the first casualty of war. That's what we're seeing.
Absolutely. Well, Alasdair, tell us about Macleod Finance. I'm going to put a link below in the description so people can check it out. Why should people subscribe?
Well, basically, I try and cut through all this BS, if you like, out of government, and try and sort of educate people. One of the things which is least understood, and not understood by economists either, is the difference between money and credit. And the dangers of credit, and really what's going on. I mean, we're in a credit bubble, etc. We're coming to the end of a fiat currency system. How do you recognize the symptoms, etc.? All those things. So it's a mixture, if you like, of explaining economics in ways which people can understand, looking at gold and silver markets, because that's where it's all reflected at the end of the day. And also geopolitics, which is driving the whole thing. I mean, we've been talking about China. Why is China doing this? China is going to protect herself against our collapse. She doesn't want to create our collapse. So she's running a very, very narrow thing. But the fact that she's coming out of the woodwork and actually actively setting things up so she can just one morning turn around and say, right, the exchange rate between gold and the yuan is as follows. Bang, that's it. And that's where we're going. People don't recognize it. I'm trying to get people to understand, wake up, what's happening, because it's time to protect your wealth, not to speculate to accumulate anymore. And you've got to understand how to protect your wealth as well. So it's all that sort of stuff. And, it doesn't cost a lot. I think that it's the sort of thing which hopefully, people will turn around and say, well, that was extremely valuable. I hope that none of my prognostications don't come true. Look at it as an insurance policy, perhaps.
Excellent. Well, as I mentioned, link is in the description below, guys. Be sure to check it out. Alasdair, always love having you on the show. Thank you so much for coming on again.
Thank you very much, Jesse.
Thank you for joining us today. This episode is brought to you by ARC Silver, Gold, Osmium. They have some great prices on precious metals, bullion products. Some of them are on your screen right now. These are subject to change, and while supplies last, so reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and pick up your copy of the replay of the first Commodity Culture boot camp. We had a great 2-hour-long session where I dove into every single stock I own in my portfolio, why I own it, and give my overall view on the commodities sector. It's available at join.jesseday.ca. The link is in the description, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.